Okay, let's go over 6-3 work together. This can be used as a guide to help you through 6-3 application problem. All right, so we're getting close to preparing the financial statements, and we're going to do something called extending the balances on this worksheet. So we have our numbers from the trial balance section. We did our adjustments. Now the only thing we have to do is transfer these numbers to the income statement and the balance sheet, and that's what's called extending the balances. Okay, so the income statement, the numbers that are going to be transferred to the income statement are going to be from lines 10 down to 16. Okay, so the income statement is going to reflect revenue or sales, as it's called. All right, sales and revenue are the same thing. So you're going to transfer revenue to the income statement and all the expense accounts. Okay, so everything above line 10 is going to be blank. So let's come over here to the income statement. And if sales is a credit here in the trial balance section, it's going to be a credit here in the income statement. So we're going to do 2,160. And then the rest of these are expense accounts, and they're going to come down here to the income statement, or over here to the income statement in the debit column. So advertising expense is 460. Cash shortened over is $6. Oops, $6. And insurance expense is 125. I will say, even though this is out here, a lot of times people make a mistake and they think that's a credit. It's not. It's a debit. It's just from the adjustment section. All right, so don't forget that that's also a debit. Miscellaneous expense is 189. Same thing, supplies expense, just like insurance expense. This is a debit, 153, and utilities expense is 550. Okay. Now, when we add up our debits and credits in this income statement section, they are not going to be equal, but we're going to fix that in the next step. Okay, so there's nothing to add here in the credit column, so I'm just going to carry down 2,160, and then I'm going to quickly add these numbers here so that I can show you that they're not equal, and they shouldn't be. They shouldn't be equal. Okay, so this amounts to 1,483. Okay, so we just extended the balances from these accounts, sales and expense accounts, over to the income statement section. Okay, now we're going to deal with this in the next section, but your sales are 2,160 and your expenses total $1,483. That's good. That means you made more money than you spent. So the difference between your sales, your revenue, and the expenses that you spent is going to be your profit, your net income. If your expenses had totaled to a higher value than your sales, then you'd be in trouble. That means you lost money. That means you spent more money than you made. So we're going to equal up these debits and credits in the next section, but we're going to transfer or extend balances to the balance sheet first. All right, so this means then the rest of these accounts are going to come over here to the balance sheet. Now, if you look at lines 1 through 8 and the types of accounts these are assets, liabilities, and owner's equity. These are the accounting equation accounts. Do you remember the accounting equation is assets equals liabilities plus owner's equity, and it always has to be in balance? Same with the balance sheet. You're going to transfer the assets, the liabilities, and the owner's equity to the balance sheet. And then, just like the income statement where these accounts up here are blank, for the balance sheet, this section will be blank for these accounts over here. Okay. So balance sheet, so cash is 4,900, petty cash is 75, and accounts receivable is 1,387. And now this is where our adjustments are going to come into play. Our supplies started out at 228, but we used 153 during the course of the month. That means we have $75 of supplies left. That's the accurate number that goes to the balance sheet. Same thing for the prepaid insurance. We started out with 375. We used 125. We have 250 balance here. Okay. Accounts payable is a 267 credit. 267 credit. And the capital is 7,443 credit. And the drawing account is a $1,700 debit. Okay, so I'm going to go ahead and add up all of these. I'll do the credit side first because it's shorter. So 267 and 7443 is equal to 7710. Hopefully I didn't make any mistakes. And let me just add the rest of these numbers here in the debit column. Oops. Maybe I did something wrong. Hold on, let me check. 4,900, 75, 1387, 75, 250, 1,700. Okay, yes, I have 83. That's true. That's correct. 8387. Okay, I just want to check one thing real quick while you guys are bearing with me. Okay, yes, that's right. Okay, I'm thinking ahead of the game. So your debits will total up to 8,387 and the credits 7,710. Okay, so again, in this step, debits and credits do not equal each other for the income statement and the balance sheet. All right, let's move to the next step. And you're going to see everything we did is completed for us up here. All right, so now we're going to calculate the net income or the net loss. Okay, so it says to calculate and record net income or net loss. All right, so right here on line 18, you're going to type the words net income. How do you know how to type that? How do you know to type that? You would type net income if you made money. In other words, your sales are higher than your expenses. So that means you made money. If your expenses were higher than your sales, then you lost money and you would type in net loss over here. Okay. So we are simply going to subtract the difference between the two. So 2160 minus 1483 equals a profit or a net income of $677. And we're going to place that under this debit column because 1483 is lower than 2160. So we're going to add this net income to this lower amount. And you'll see that these two added together, since we just subtracted this 1483 from this 2160. So these two added together equal 2,160. And then you carry down your 2,160. Okay, so now debits equal credits in the income statement. Okay, and you know accounting, where there's a debit, there has to be a credit. Okay, so let's calculate the difference between the two totals on the balance sheet. It's 8387, and this is what I was calculating in the last step. I just wanted to make sure I was doing it. I didn't have a mathematical error. So yes, so the difference between the totals on the balance sheet is also going to be equal to the net income of 677. You're going to enter a credit this time. All right, this 677 plus this 7710 surely equals 8387 because we just subtracted that. And then you carry down your 8387 and your debits equal credits. Okay, just 1 second before I stop the video, I'm going to explain why the net income is entered as a debit on the income statement and why it's entered as a credit on the balance sheet. Okay, net income or profit is money. And when a business makes money, it increases the owner's equity. Okay, I think we learned that in the very beginning of the year. Any type of net income or profit or sales or anything like that is made increases owner's equity. All right, owner's equity increases with a credit entry. So we have to enter this net income as a debit on the net income because it's going to be entered as a credit on the balance sheet. Okay, so this 677 is a credit on the balance sheet because on the balance sheet we have owner's equity. Owner's equity is listed up here, and we know that the way to increase owner's equity is with a credit entry. So we have a 677 credit entry on the balance sheet, meaning then we have to have a debit entry on the income statement. Okay, and I'm going to stop here and proceed to the next.